Treasury buybacks are ramping up, but why? What is really going on here? If you pay attention to financial news, you may be seeing headlines like this pop up left and right. Treasury buying back $1 billion one day, $2 billion next day, or like on October 1st, $4 billion in one day of their own debt. That's what a Treasury buyback is. Comparing the buybacks this year versus last year, you can see that the pace and volume of Treasury buybacks has increased rapidly. It is essential to understand what a Treasury buyback is. Very simply, it's when the US government borrows more money in order to pay off some of their debt early. Right now, the US government has a whopping $37.8 trillion in debt, and the budget deficit for 2025 is $1.9 trillion. The deficit is the amount of money that the government borrows because they've spent that much more than they took from us in taxes. Imagine you're making $100,000 per year, but you're spending $200,000 per year. The only way you're going to be able to do that is if you are borrowing the difference. In your situation here, if you were going to do something similar to a Treasury buyback, it would be simply like placing your mortgage on a credit card. You're paying down some of your debt, a small amount of your debt, with new debt, basically a balance transfer. Given that the US government owes a total of about $38 trillion, seeing buybacks of up to like $4 billion in one day is really just a drop in the bucket. It's peanuts, it's nothing, but it is ramping up. And this brings us to the first misunderstanding that people have with these buybacks, which is that many people think this is similar to QE, that the US government is performing quantitative easing on its own without the Fed. This couldn't be further from the truth, because with a Treasury buyback, if the government is running a deficit, there's no net change to the financial system. If it buys back one of its bonds before maturity to pay that debt off, it must borrow new debt from somebody else, which means the amount of debt or collateral or assets in the financial system is exactly equal to the amount of cash in the system. There's no change there. This is different than when the Federal Reserve performs QE, where they print money into existence, they create dollars out of nothing in order to buy assets out of the financial system. That does increase the money supply. But when the federal government buys its own debt back, it can only do that by borrowing from somebody else, unless it's running a surplus, which it's not doing. This brings us to the second misunderstanding of why people think the US government is doing these Treasury buybacks, and they think it's because the federal government is trying to lower the cost of interest on its debt. However, like we showed before, the United States government owes $38 trillion. Despite the fact that interest rates on longer term bonds like 30-year treasuries or 20-year treasuries or 10-year treasuries are higher right now than they are on short-term debt like 1-year bills or 6-month bills, they're still only buying back $1 billion here, $4 billion there. And even if all of that, which it's not, but even if all of that were to retire long-term debt with higher interest rates and they were replacing that with T-bills with lower interest rates, it's still not going to make a difference on the $1 trillion they're spending on interest alone on the $38 trillion debt pile every single year. By the way, guys, you're gonna see by the end of this video why this is all leading to inflation and they're gonna try and print their way out of this. And I'm sure you probably agree with that already. So if you are interested in learning how to make money as the dollar continues to fall, this Thursday, October 9th, it's at 7 p.m. Eastern time, I'm going live. I'm gonna detail a trading strategy that I've never talked about anywhere else. This is one that I believe is set to soar as the Fed fires up those money printers again, and it's already starting to move. This has nothing to do with stocks and nothing to do with asymmetric trades. This is in a different category altogether. And because this strategy is so unique, I'm going to offer a special beta test invitation to a small group of people on the call. So if you're interested in learning what this strategy is and to hear how I've already been using it in my own personal account to take home double and even triple digit returns over the last year, All you have to do to show up is click the link in the description below to register. Not only is attendance on this Zoom call completely free, but just as a thank you for showing up to the call, I'm going to give out 2 free stock picks at the end of the Zoom. Just make sure you sign up soon because spots are limited. Look forward to seeing you there. Now, lucky for us, the Treasury actually tells us a few things about these buybacks, including why they're doing them. And also, unlucky for us, it shows us some insight based on history on what we should expect from things like this needing to take place. What do I mean? We can take a look at the Treasury's schedule of planned Treasury buybacks, and we can see for the rest of the year, the size of the buybacks, 4 billion, 2 billion, 2 billion, 4 billion, 4 billion, 2 billion, 2 billion, 500 million. We can see the dates that they're planning on doing it. We can see the maturities that they're planning on retiring or buying back. But this column is the most important. We can see the stated reason for that particular buyback, and we can see it is liquidity support. Liquidity support is a euphemism. Liquidity in financial markets means if there is a buyer, then there is a willing seller at a near price. If there is a seller, there is a willing buyer at a near price. A very liquid market is one where there are lots of buyers, lots of sellers. There is a very tight spread between the bid and the ask. There's high volume on these transactions, and there's enough depth to this liquidity that large money, big players can move massive amounts of money in and out without drastically changing the pricing in this market. So what do you think it means when the US government comes in and starts buying billions of dollars in Treasury buybacks in order to support liquidity? It means that the market needs the US government to come in to support the liquidity. It means big financial players are not there buying and selling this debt enough, which means that large purchases or sales could actually move the market. It means there could be big differences between the bid and the ask, large spreads. It means there could be volatility that could undermine confidence in the US Treasury as the foundation of the global financial system. In other words, the US government is there providing support for liquidity in order to reinforce confidence, but the very fact that they have to do this undermines that confidence. Sure, it allows people to know that if push comes to shove, the US government will be there to soak up liquidity if needed. But the very fact that you need that reassurance is problematic. Now, we've seen this thing play out before in world history, and the most important example of this is the Mississippi bubble. If you're not familiar with the Mississippi bubble, there was a man named John Law who convinced France to allow him to start a central bank in France. He had all these economic plans, and it hinged on him being able to print money into existence. So what he did was he gathered up all of the gold and silver from all the citizens and said, turn in your gold and silver money. I will give you paper money instead. The central bank also owned the Mississippi Company, which owned land in the United States. And so this new currency that the central bank in France issued was backed up by metal and land. This was, like every central bank, a fractional reserve bank, which meant he issued more paper than there were actual reserves to back it up. This was necessary for him to spend as much as he wanted to spend on his economic plans. If you know any bit of history at all, you know this started to cause inflation. In other words, the value of that currency to start to drop. This caused John Law to get a great idea because he was looking at the situation thinking, my currency is falling in value, but my currency's value depends on the value of gold and silver, which I can't change, but it also depends on the value of this Mississippi company, which I can change. Because if there's more purchasing of these shares of the Mississippi company, that will drive the value of those shares up. If the value of the company goes higher, then that stops the fall in the value of my currency because my currency's value is dependent on the shares of the Mississippi company. So I bet you can guess by this point what he did. He started printing more money in order to buy up shares of the Mississippi company to try and drive the share price higher in order to keep the value of his currency high. You can probably guess how well that went. It didn't. In fact, it was because he was causing artificial buying to happen of the Mississippi shares that anybody who owned them realized that they were overvalued and they could sell as many of these shares as they wanted, and the central bank would have to buy them all up, because if they didn't, the value of the currency would plummet. And so it gave instant exit liquidity to everyone holding shares of the Mississippi Company, and the central bank had to buy them all up. Once all the selling was done, the Mississippi Company was worthless, and so was the currency. Now, I'm not saying that something like this, at least quickly, is happening with the US dollar and treasuries right now. But you can certainly see the similarities, because the value of the dollar is dependent on a lot of things, including the fact that the US Treasury is the financial bedrock of the global financial system. It is the foundation, and confidence in US Treasuries is being undermined by the fact that there's $38 trillion worth of them floating around in this world, and that number is increasing by about $2 trillion a year right now, and that amount is accelerating. And though Treasury buybacks are not printing money in order to buy back the shares, ultimately, we do get to a point where the Fed does have to step in and print money to buy up these treasuries. And when a central government in coordination with the central bank has to maintain the value of its debt through printing, and the debt is what gives the money its value, you've entered the end game. We're definitely not there yet, but seeing small liquidity support buybacks like this certainly looks like the beginning, or maybe the beginning of the end. And if you think there's any way out of this mess other than the US government trying to print its way and inflate its way out, then I have a paper bridge to sell you. But if you think inflation is the most likely outcome given everything that we face, and again, you're interested in learning how to profit off of this situation over the next coming quarters and years, on Thursday, this Thursday, October 9th, it's at 7 p.m. Eastern time. I'm going to explain to you my strategy and offer an invitation to my beta test, so don't miss it. The Zoom call is free. Spots on the beta test are limited. Sign up with the link in the description below. As always, thanks so much for watching. Have a great day.